Hey everybody, I hope everyone is doing well and had a good day today. And in this video, I'm going to review the Emini 5-minute chart for Tuesday, September 30th, 2025. The horizontal blue lines represent yesterday's low and yesterday's high. Important to know going into the day, the prior day's low, when we open above it, usually acts as support. The prior day's high, if we're opening below it, is usually resistance. And it's also important to know that markets are fractal. Price action is a fractal phenomenon, and it doesn't matter if you're looking at the 5-minute chart, or the 1-minute chart, or a daily chart. Most bars break out of the prior high or low of the prior bar. So most bars are actually breakout bars. If you look at any chart, just ask yourself and take a look at it. How many bars are actually inside bars? If you look at yesterday, maybe bar 6, and through here, bar 9, bar 19, 24, 32, let's see, 35, 36, 44, 47, 50, 54, and I may have missed a couple, but it looks like there's about 11 inside bars, and that's out of 81 bars. So if we do the math on what's 11 divided by 81, that's only about, I forget exactly, it may be 12% or 15% tops. So call it 15% of the bars on any given chart, roughly, are inside bars, which means 85% or more of the bars are actually breaking out. So generally speaking, there's about an 85% chance that any given day is going to break out of the prior day's high or low. So that's why for these reviews, I always try to draw the prior day's high and low, because they act as magnets and they act as important support and resistance on the higher time frame. So going into the day, we can see using the RTH chart, there's a gap down, not a very huge gap down, but a decent sized gap. And if we imagine the gap down as simply a bear breakout, it's basically a breakout and follow through on the open. You can call it a micro channel. We have trending highs going from bar 79 into the close and into the open of today. Whatever you call it, the breakout and follow through on the open is strong enough that it's probably going to get a second leg down. But what's the problem with selling bar 1? The problem with bar 1 is that it's right at support. And if we draw, this is kind of a best fit horizontal line of support. Support and resistance are not just one magical line. It kind of acts as a zone. And so maybe this is the actual support level that the market is responding to. Maybe it's a little higher, a little lower. We can see tested it a few times here, small overshoot here, bigger overshoot here, and testing it again on bar 1. So we know there's a support zone somewhere in here. That's the problem with selling bar 1. If you think about selling, let's say you want to sell the close bar 1, put a stop above bar 1. A couple problems with it. The first is, like I said, the market is right at support, but also in general, maybe 20% of the time, bar 1 remains the high or the low of the day. And if you just look back at any given day, you can do a pretty quick study and find that that number, 20%, is pretty accurate. So if most of the time, 80% of the time, bar 1 does not remain the high or the low of the day, then if you're selling bar 1, stop above 1, you're betting on a low probability event. Also, most of the time, it's a trading range open. It's not a trend from the open most of the time, so you usually get something like this on the open, in this case a wedge top, or some kind of breakout mode, double top, double bottom, or wedge top, wedge bottom. So on the open, you're expecting a trading range 80% of the time, and you're not expecting bar 1 to remain the high or the low of the day. So as far as selling bar 1, stop above 1, it's probably not ideal because you'd be selling right at support and you're putting your stop right where the market is probably going to test 80% of the time. And then bar 2, hesitation. It's a pause bar. So we did not pull back. We did not go above the high of bar 1, but it's a pause. We went sideways. It's a trading range bar. Bar 2 is a doji. What's the significance of a doji or a pause here on bar 2? The problem with the pause on bar 2 for the bears is that, okay, they had a decent breakout. It's a gap down and follow through, so the market accepted the gap down. Price moved a fair distance from up here down to the close of bar 1, so there are certainly trapped traders above, and there's probably going to be a second leg down. But what's the problem with selling bar 1? If you're selling bar 1, you're selling right at support. And at support, what do you expect the market to do at support? You expect sell-offs to at least pause, if not reverse. And then here's another sell-off that reversed up, and we're trying to sell off again, but we're at least hesitating. And the problem here is that if you're selling the close of 1 and your stop is at the pivot point up here, or even if it's at the high of bar 1, you're hoping for a bear breakout below the entire trading range. And if you're going to be selling with bad risk reward being reward equal to your risk, so 1-to-1, you need high probability. And if you think about Al's 80% rule, 80% of breakouts of trading ranges fail. So do you really want to take a trade with 1-to-1 risk reward and maybe, it's a low probability trade, especially when you get the hesitation on bar 2? We have to measure momentum with the bars on the chart. Momentum, it's the same equation as velocity or speed. It's simply distance divided by time. So we can take the price axis and divide distance, price, by time, number of bars. The more this stalls and hesitates, the more antsy the bears are going to get, because the bears, if they're selling, they know they have big risk, they know their potential reward might be limited, and the only way you can justify selling low in a trading range below the average price and at support is if you have momentum. But is bar 2 representing strong momentum for the bears? No. It's going sideways and hesitating. So the premise for the bears is becoming weaker, and there's a reason for the bulls to buy at support, possible sell vacuum to support low in a trading range, and then we're getting confirmation with a pause bar. So 3, we get a strong bull trend bar, but 3 has a similar problem that bar 1 had, and that is it's a strong bar. It's probably going to get a second leg, but the location is bad. If you're buying the close of 3, you're forced to buy right below the moving average, and if we look to the left at the trading range, we can see there's resistance here. Again, resistance is not a perfect one horizontal line. It's a zone, and the zone might be something like here. So maybe there's a little bit of room to the upside for the bulls. However, like I said, the gap down and bar 1 is probably going to get a second leg down. This could simply be, maybe it's a 50% pullback of the sell-off. That's exactly testing 50%. So the bears are likely to get a second leg down. The bulls will probably not buy as we approach the top of the range. Rather, the bulls will wait for the bears to get their second leg, and then bar 3 is setting up a low 1 short, but the low 1 to sell below the low of bar 1, to sell below bar 3 is not very logical because it's a strong bull trend bar, it's a weak sell signal bar, and it's a low 1 at the bottom of a trading range where traders are more likely going to be looking to buy. So rather than buy the close 3, and if we think about this logically for the bulls, rather than a bull buying the close of 3, putting a stop below 2, which doesn't really make sense because you're buying near or at resistance, the moving average, near the top of the range, and your stop is below bar 3 or bar 2, which is in the support zone. So do you really want to put your stop loss to sell out of longs right where strong bulls are probably going to be buying? This is the buy zone where bears are looking to buy back shorts and bulls are looking to buy to go long. So it really doesn't make much sense to buy bar 3, stop below 2, unless you're going to be really quick to exit. This is another momentum trade. It's similar to selling the close of bar 1. So bulls who buy will be very quick to exit if they're disappointed. And that's what happened on 4. 4 rallied at first, but then hesitated. Bulls were quick to exit, and we got another sell vacuum because bulls not willing to buy here because there was not sustained momentum. They would rather buy value. They want to buy lower, below the average price, and in the support area, low in the trading range. Now 4 is the low 1 short, but there's probably buyers below 4, scaling in lower. We may have to test yesterday's low, which is a test magnet. Bar 5, it's a bear breakout, but low in the trading range, and it's leg 2. Gap down in bar 1 is leg 1. Deep pullback, maybe a 50, 55%, 60% pullback, and then leg 2. So lots of overlap, pullback, fairly deep. We know it's a trading range. And then a second leg down to support. So more likely, this is the buy zone. This is support. And bar 5 as a signal, bar 5 alone, if we think about it, would you rather sell the close of 5, put a stop above 5, and go for a measured move based on that height? Or would you rather take the opposite side of the trade and fade the breakout, buy the close of 5, put a stop, a measured move down, and target the high of the bar? A late leg low in a trading range usually is going to get bad follow through and fail and end up reversing to the mean. The mean is somewhere in the middle of the trading range. So maybe this purple line, somewhere in the middle of this trading range. In a trading range, you're looking to fade late legs for mean reversion. So we can see what happened on bar 6. Market went a little bit lower, got close to yesterday's low, and then reversed up in a strong way. 6, strong enough bar that there are trapped traders who sold below 5 or sold for any reason. Bulls who bought maybe got trapped out selling with a stop below 2. For whatever reason, traders who sold down here got trapped on bar 6, and those who did not buy are also trapped on the sidelines. So 6 is a strong enough bar that it's probably going to get a second leg up, but it has the same problem as bar 3 now. You're back at resistance, so this is not an ideal place to be looking to buy. So rather than buy the close, bulls would rather look to buy a pullback. Bulls get a weak follow-through bar, and maybe they look at this as a reversal and follow-through, and they look to buy the 50% pullback right here. Sell vacuum, bar 8, bear breakout bar, but again, testing this horizontal support level. So it's similar to bar 5 or bar 1. You have 1, 2, 3 attempts down. You can call it a head and shoulders bottom, left shoulder, head, and right shoulder. If the bears do not get momentum and sustained selling on the next bar, they'll probably be quick to exit, and the bulls will look to buy for a second leg up. And that's what happened on bar 9. So the bears did not get momentum, might be a head and shoulders bottom. Bulls will probably buy, looking for a second leg up, and the bears who are trapped are probably exiting above bar 9. So a reasonable stop order buy above bar 9. 10, bull breakout but big tail and testing resistance. Upside probably limited, but 6 and 7 may need a second leg to test the high of that. Needs momentum like on bar 1, and if they don't get it, like a hesitation on 2, a pause bar, or like 9, then they may be quick to exit and they may look to sell higher. So this might be the start of a second leg up. 1, deep pullback, maybe 2, bears wait to sell higher in the range. That's what's happening on bar 10, testing higher in the range above the strong bear bar. 8, sellers above, upside might be limited. Micro double top, up, down on 10, up, down on 11. So you can see sellers above bar 8 near the top of the range. Bar 11, so we went up, down, micro double top. Bears can argue head and shoulders top, left shoulder, head and right shoulder. Maybe higher highs on the open, lower lows from yesterday into today. So maybe it's an expanding triangle trading range. 12, we went sideways in the middle of the range, not really great for buying or selling, probably sellers above and buyers below. Outside bar 13, so we tested higher in the range near resistance and found sellers. As far as buying below 13, probably buyers below, but we may have to go lower and test other levels of support. Because the prior day's high and low is a magnet, we are close to yesterday's low. We haven't quite gotten there yet. I suspect we'll have to test yesterday's low. And then 14, a sell vacuum testing yesterday's low. So 14, it's a big bear trend bar. Testing support, yesterday's low, and then if it's an expanding triangle, which it might be here, also testing the bear channel line. So what about bar 14? It kind of reminds me of bar 5, although this is even worse for selling in general than bar 5, because 14 is a very big bar. So big bar means big risk. That's if you're putting a stop above 14, if not above 13. So big bar, big risk. And then structurally, the context, it's a late leg. So you have 1, 2, 3, maybe 4 legs down to the channel line to support in a bear channel or in a trading range. So bad risk reward, and you're selling right at support, channel line, and yesterday's low. So not really good for selling. So because everything has an opposite, a bad stop order sell is a good limit order buy, which means there might be more traders buying the close of bar 14 than selling the close of bar 14. And we can see what happened on 15. Strong reversal bar for the bulls. 15, probably leg 1 at the bottom of a developing trading range. It's okay to buy. Traders will probably buy 15 and use a wide stop, maybe a measured move down of 15, because if we fall below 15, there are probably buyers there. So not ideal to put a stop below 15, but in this case, strong follow through. Traders immediately made 1R, and that's going to attract profit taking, not to mention we're back at resistance in the top of the trading range. 17, a weak reversal bar compared to 15 and 16, probably minor 15 and 16. In other words, 15 and 16 probably need a second leg up. But as far as buying here, it's hard to look to buy when you're at the top of the range. Traders will buy a deeper pullback, but in this case, we did not get that. So the bulls get their second leg up, and now we're testing high in the range. We have the bull channel line of the expanding triangle. We also have this resistance line from yesterday. So similar to down here where we had the channel line and yesterday's low support, that makes 14 a bad sell. This is why 19 not a very good buy. It's a 5-bar micro channel, yes, but the context is bad and you got to pause in between. So breakout, pause, second leg, and now you're at resistance. So probably more sellers in this area. Hesitation, and then 21, bear breakout. 21, similar to 15, where you have several legs up, and it's probably leg 1 at the top of the range. So 21 might be a sell to close bar, and option to scale in higher, probably not ideal to use a stop above 21 or 20, but selling the close and scaling it is okay. And then this one got immediate follow through down to a new low, but expanding triangle. So now we have another leg down, 3 pushes down at least, 2 support. So now we're back in the buy zone. Better to look to buy down here. Bears will take profits and bulls will scale in because it's a stairs pattern. When we fell below bar 6, traders who bought below 6 got filled on 14, made money 15, 16. So if a bull made money buying the prior low, they're going to do it again. They're going to buy at the low of 15. They're going to buy at the low of 15 during 24 and probably make money. 25, kind of similar to 15 and 21, where it's leg 1, reversing a late leg at support or resistance, in this case support, in a trading range. So I think buying the close of 25 is probably okay, but using a stop below 25 is not a very good stop location. Maybe below 24, ideally you use an even wider stop, because the reality is that if we fall below 25 and 24, there are probably more buyers at these support levels than sellers. So bear breakout, it's a micro channel. Pullback, will probably get a second leg, so we probably will not just reverse straight back up. We probably need to hesitate first. But 25 is a weak low 1 near support in a trading range, so probably buyers below 25. And then 26, again, kind of similar to bar 5 and bar 14. It's this second leg, but in a support zone. So probably a better buy the close bar than sell the close. Hesitation, so it's like what I said on bar 1 and 2 or 8 and 9. Bear breakout bar, but at support you need momentum, sustained momentum, to justify staying short at the bottom of a trading range. And 27 is an indication that the bears are not in control. It's a bull doji. And because of that, it might be a buy the close bar, because bears may be panicking out of shorts, knowing that they might be selling too low in a trading range that could test all the way up here. And bulls may be desperate to get long because the market is testing value below the moving average, testing these support levels. Maybe it's an opportunity to buy at a great price. And then 28, kind of similar to 15 and 21, this kind of a reset, leg 1 at support in a trading range, probably buy the close 28 with the option to scale in. Stop below 28, not ideal, because if we do fall below 28, there are probably buyers below. And then in this case, bulls got some follow through. 29 was a bad sell, probably buyers below. The breakout and follow through is likely to get a second leg. Was this the second leg? It might be, but because markets are fractal and usually get a second leg in different forms, so you first get the breakout and follow through, the immediate pullback, an immediate second leg, then there's usually a more complex pullback, and then a more symmetrical second leg. Is 31 enough to reverse all of this buying? Probably not. So probably buyers below. This is part of the pullback, and the bulls should probably get another leg up. So range expansion, range compression through here, and then we'll probably get range expansion up again, which we got on 34, 35. Now you can see 35 testing the bull channel line at the top of the expanding triangle, so resistance area here. Bulls had 2 legs up to the top of the trading range. You know that after 2 or 3 legs in one direction in a trading range, the market usually reverses. So good opportunity to take profits on longs up here, and bears will sell above the prior high, bar 20, or even over here, bar 77 yesterday. Bad high 136, sellers above because you're trading leg 2 for leg 3 at the top of a trading range. Low probability, traders will sell above and scale in. High 1, high 2, sellers above 36, sellers above 38. These are usually better opportunities to look to sell. Even though 39 looks like a strong bar, lots of overlap and a tight trading range for the past 4 or 5 bars at the top of a bigger trading range, so 39 might be a sell to close bar. 40, a leg 1 bear breakout, probably sell to close, scale in. Bears get immediate follow through. Spike and tight channel. It's a micro channel. On a smaller time frame, it's a spike and tight channel, which is a breakout on this time frame. Probably have to go a little bit lower before the buyers come in. We may even test a new low of the day because it is an expanding triangle at this point. Finally getting some pauses, another sell climax, another pause, another sell climax. So this is another area where it's a bear breakout bar, but it's back at support. Probably better to look to buy here, but this is very tight. Might need a second leg of its own. So it's a little bit aggressive to buy 47, but not unreasonable to do. Here's some hesitation. Micro double bottom, down, up 48, down, up 49 at support. Stop order bulls might start to buy here because the risk is small and the potential reward is huge, and the structure is logical that this is an expanding triangle. We're back at support in the overall range of the day, and we may reverse back up here and test the highs. Bears still may need a second leg down, but the more we hesitate here at support, the more the bears will give up and just take profits, and the more the bulls will come in and get aggressive. So 51, low 1, but probably buyers below 51. In this case, it's by the close, 52, bull breakout, probably going for at least a measured move up of bar 52. Smaller follow-through bar, the market pulls back, but then it's about a 50% pullback of the rally. So 54, probably by the close, bull breakout, 50% pullback, probably get a second leg up. What about for the bears? Is it a pullback for the bears? Bear breakout, maybe 60% pullback, second leg down. The problem is that this is too strong. 52, 53 really broke this bear trend line. So we broke the bear trend line, we retested it, and now you have bears desperate to get out who got trapped on 52, 53, testing the breakout point, 51 high. So the downside here is probably limited. And then the bulls get their second leg up. $56 and 57, a couple of bars that are actually unlike any other bars on this chart. And I know you could say they're similar to 15 and 16, but notice the overlap with the prior bars. 56 overlaps the prior bar by about 20%, maybe. 57 overlaps the prior bar by maybe 10%. So there's very little overlap with the prior bars, 57 and 56. They're also uniform in size. It's not like one's a big bar followed by a smaller bar, like here, or here, bigger bar, smaller bar. Much more overlap, 21 and 20. So these bars are really different. And for the expanding triangle, you can see the bears are no longer getting to the low. So here's the last low, 24. Bulls would have bought here as they bought below 6 and 15. They would have bought below 24, but the market never got there. That's a sign of urgency. And we're getting a higher low. So the bulls may be stronger. And then this might be a measuring gap. So it's possible we rally for a measured move to a new high up here and then test the bull channel line of the expanding triangle. So 57, what about selling the close 57, second leg trap, 1, pullback 2. This is too strong, I think, because of the little overlap and the uniformity and the size of the bars. Even though the location seems to be good for selling, this needs a second leg. It's better to wait for at least that hesitation to then look to sell. Is 58 enough hesitation? Would you sell on a stop below 58? Probably not. This is too strong. The bulls need another leg up, and the bears, the selling pressure through here is not enough. What about here? It probably is a breakout period of sideways, and then the bulls need a second leg up. The bulls are actually getting closes above this level of resistance that I had drawn here. undershoot here, test here, overshoot, but no closes above. But here they're actually getting closes above. And then we're breaking out again. So 1, 2, maybe leg 3. And then a vacuum up near the channel line. I've got to speed it up here. I'm running low on time. But you can see the bulls ultimately reached the expanding triangle bull channel line. We got to yesterday's high. It ended up being an outside up day. But late in the day, consecutive buy climaxes, 76, 77, ended up being an exhaustive buy climax, which ended up reversing and testing the low of it almost right away. All right, that's going to be it for today's end of day review. So thanks everybody for watching, and I hope everyone has a great night.